Ready to dive into the world of investing? It's a great way to grow your money over time, like a treasure hunt, and we're here to help you find the gold. Right.
That's a great analogy. And you're in the right place. We're going to break down the basics of building long-term wealth from your research, focusing on stocks, bonds, and real estate.
You're investing 101,
Right.
a roadmap for your money. And you don't need to be a Wall Street whiz to understand this stuff either.
You got it. Understanding these asset classes can really empower you to take control of your financial future.
Absolutely. So let's start with stocks. They're often called equities, and I know financial jargon can be confusing, but stick with me here. When you buy a stock, you're essentially buying a tiny piece of a company,
That's true.
like a tiny, tiny sliver of all those iPhones Apple sells. You become a shareholder, and that means you have the potential to benefit from their success.
It's like you're putting your money where your mouth is. If Apple does well, your investment potentially grows right alongside those profits.
It's exciting to think about, right? But, and there's always a but, when it comes to investing, stocks are known for being kind of volatile, up and down, up and down.
That's for sure, but that volatility is actually a key consideration. Because here's the thing, despite those ups and downs, stocks have historically outperformed other assets over the long run.
Interesting. Why is that?
One major reason is, believe it or not, inflation. Prices go up over time, right? Companies increase their prices too, leading to higher profits. Well, ideally,
And higher profits mean what?
higher returns for you as a shareholder. Potentially, at least.
Makes sense.
But another factor is that the global population keeps growing. More people means more customers for businesses. That's more people buying those iPhones, more people shopping on Amazon. You see where I'm going with
The
it?
growth potential.
Exactly. But, you mentioned volatility earlier for a reason. Even those giant companies, they can have a bad year or even a few bad years.
They do.
That's why it's so fascinating to look at historical stock charts. Take the S&P 500, that's 500 of the biggest U.S. companies, right?
Right.
You see periods of incredible growth, but also some dips along the way. Remember 2022?
Yeah, definitely not a banner year for stocks.
And even with that dip, though, the long-term trend has still been upward.
So maybe those dips are buying opportunities in disguise, at least for those who are playing the long game, right?
That's a perspective a lot of seasoned investors have. It's why patience is so important with the stock market.
It really is. And this is where the magic of compound interest comes in too, isn't it? It's like a financial snowball effect.
It's such a powerful concept.
Our research had an example, investing $1,000 with a consistent 5% annual interest rate.
Right, so that first year, you're earning $50. Not life-changing, I know.
Not exactly a fortune,
Hmm.
but what happens next?
Here's where it gets interesting. The next year, you're not just earning interest on that initial $1,000. You're earning interest on the $50 you made the previous year, too.
You're earning interest on your interest. It just keeps building.
Exactly. It starts small, but it can grow so much over time. That's the snowball effect in action.
I love that analogy. And the longer you let that money compound,
The more dramatic those results. That's a key takeaway here. Time is your friend.
it reminds me of that saying, the best time to plant a tree was 20 years ago. The second best time is today. Even if you start small, that power of compounding can lead to huge growth, right?
That's exactly right.
We use that online calculator from the source material earlier, and it's amazing to see this in action. We plugged in $400 a month for 10 years, assuming a 7% return.
That's something a lot of young investors are doing, consistently investing a little bit every month.
And after 10 years, you know what? It's almost $70,000.
Really drives home the point that consistency matters. Let your money work for you.
Okay, so we've seen how compound interest can turn those consistent contributions into serious growth. But how do you actually get started with stocks?
That's the million-dollar question, right?
It can feel intimidating. Like, where do you even begin?
It's true. The world of investing can feel overwhelming, especially for beginners. One of the first decisions you'll face is active versus passive investing. A lot of your research touched on that.
Right, active investing, it's like being your own stock-picking guru, yeah?
Yeah.
Researching individual companies, trying to find the next big thing, maybe even doing some day trading.
It's definitely tempting, trying to beat the market.
It is tempting. But active investing, it takes a lot of time, research, a bit of luck even.
You got it. Remember that analogy from the prep comparing it to cooking gourmet meals every night? It's possible to do, but it takes a lot of work.
I like to cook, but maybe not every night.
Exactly. So passive investing, think of it more like choosing a balanced meal plan. Someone else has done the hard work, crafted these delicious, nutritious recipes, and you get to enjoy the results.
That definitely sounds more my speed.
It's a strategy that a lot of successful investors use. Essentially, you're entrusting your money to experts fund managers who handle the investment decisions for you. And a popular way to do this is by investing in index funds.
Index funds, those are like baskets of stocks, right?
Yep.
They track a specific market index, like the S&P 500 we were just talking about.
Exactly. It's an easy way to get exposure to a diverse portfolio of stocks all at once. So you could pick an S&P 500 index fund. There you go. You've got 500 of the largest US companies. Or you could look at something like the MSCI World Index that includes companies from all over the globe. Even more diversification.
So instead of trying to pick individual stocks, you're betting on the overall performance of the market.
That's a great way to put it. And historically speaking, the market tends to trend upward over those longer time periods.
Makes sense.
Of course, past performance isn't a guarantee of future results. That's investing 101, right? But it shows you the potential of thinking long-term with a passive approach.
It does. And in fact, one of the articles you sent mentioned that for truly long-term investing, like 10 years or more, a simple low-cost index fund can be incredibly effective.
It's true. The data's pretty clear on that. Consistently investing in index funds, it's led to solid returns over time.
Now, you said low cost.
Yeah.
And that reminded me, we were also talking about ETFs before. Exchange-traded funds. Are those similar to index funds? I always get those two mixed up.
It's easy to confuse them. They are pretty similar. They often even track the same market indexes.
They do.
Both are excellent choices if you're interested in passive investing, but there is a subtle difference. ETFs, they trade on stock exchanges, just like regular old stocks. But index funds, you typically buy and sell those through mutual fund companies. It's a little nuanced, but it matters. Index funds, because of their structure, can be a bit more tax efficient, especially if you're planning to hold your investments for a long, long time.
Interesting. So if someone's in it for the long haul, that's something to consider.
Exactly.
Right.
Aligning your investment choices with your goals.
Makes sense. Actually, in your research, you even had a couple of specific examples. The iShares Core S&P 500 ETS, ticker symbol IVV, and then the iShares MSCI World ETF, that one's URT.
Those are great examples. Both of those are really popular ETFs. They track those major indexes we've been talking about too.
Perfect. We'll be sure to link those in the show notes so everyone can check them out. So we've covered a lot of ground with stocks. Ready to shift gears and talk about bonds a bit?
Let's do it. Bonds, they offer something a little different. They're often considered the safe investment, especially compared to stocks.
Bonds. They always seem to get labeled as the safer investment, especially compared to, well, those roller coaster stocks we were just talking about. Why is that?
So bonds, they're kind of like IOUs.
Okay.
Issued by governments or companies. When you buy a bond, you're lending them money, essentially, and they promise to pay you back the full amount on a specific date. Plus interest payments along the way, those are often called coupons.
Coupons. So instead of owning a little piece of a company, like with stocks or the bond, it's more like I'm the bank.
Yeah, that's a good way to think about it. And you're right, bonds often are seen as a safer option, especially when things get shaky in the stock market. Investors tend to look to bonds to kind of protect their money. And right now is interesting because with interest rates rising, bonds are looking more attractive than they have in years.
Because those interest payments, the coupons, they're higher now than they were, say, a year or two ago, right?
Exactly. New bonds, they're being issued with higher yields. And for investors, that can mean a nice, steady stream of income. Plus, a lot of experts are predicting that interest rates will eventually come back down. And if that happens, the value of bonds you buy today could actually go up.
Interesting. So higher interest payments now and the potential for them to be worth even more later.
You got it.
Now, I do remember us talking about something called duration when it comes to bonds. What exactly is that?
Duration. Yeah, that's key, especially if you're thinking about potentially profiting from falling interest rates. So basically, duration measures how much a bond's price will change when interest rates change. Remember that seesaw we talked about?
I think so.
Well, imagine short duration bonds as being closer to the middle of the seesaw. They don't move up and down as dramatically when rates change. Longer duration bonds, those are like sitting way out on the edge of the seesaw. Big swings when rates move.
Okay, that makes sense. So let me get this straight. If I think interest rates are going to fall, I might want to look at bonds with longer durations, right? Because their prices, they could increase more as rates go down.
You got it. But remember, longer duration also means more risk, because if rates go up, not down, then the price of that bond could fall more too.
A trade-off. It always is with investing, isn't it?
It really is. It's about finding that balance, considering your own personal risk tolerance.
For sure. Okay, so shifting gears here a little bit from the world of stocks and bonds to something a little more, well, tangible, real estate. It's something that we can all kind of wrap our heads around, right? We understand owning a home or an apartment. But you found some fascinating research about real estate as an investment, not just a place to live.
Yeah, real estate can be really powerful for building wealth. Absolutely. You've got the potential for passive income if you think about rental properties.
Yeah.
And then there's the potential for the property to go up in value over time.
Right. Those videos you shared about rental properties in Seville and in Madrid, it really showed how hands-on you have to be, though. Not exactly passive.
That's the thing about real estate. You might need to be a bit more involved than with stocks or bonds. You've got to be prepared to deal with things like, repairs, maintenance, maybe even difficult tenants. Things happen.
So not exactly a completely hands-off way to make money.
It takes some work, comes with its own set of risks too. But one of the most powerful aspects of real estate is leverage.
Ah, leverage. Now things are getting really interesting. What is it about leverage?
It's basically using borrowed money like a mortgage to try to amplify your returns.
Amplify your returns. I like the sound of that.
Your research had that great example, remember? Comparing buying a $200,000 property with cash versus getting a mortgage for, say, 75% of it. With the mortgage, you're putting down less of your own money up front, but if the property value goes up, your return on that initial investment is bigger.
Because you use that leverage. It's like you're putting a smaller amount of money to work, but potentially reaping larger rewards.
Exactly. You got it. But, and this is a big but leverage, it can work both ways.
How so?
Well, if the value of the property goes down, you're amplifying your losses too. It can magnify things good or bad.
Definitely something to keep in mind. So it's not a guaranteed path to riches, this real estate game.
It's not a get-rich-quick scheme, that's for sure. It takes research, careful planning. You got to go into it with your eyes wide open. And I'd say that's true whether you're talking about stocks, bonds, or real estate. Understand the fundamentals. Figure out how much risk you're comfortable with, how long you can let your investments grow. And you know what? If you're ever feeling lost, go back to the research. There's so much valuable information out there to help you make those smart decisions.
Absolutely. Knowledge is power. And hey, that's what we're all about here, right?
Yeah.
Giving you the information you need. We'll make sure to link to all those resources we talked about in the show notes. So, wow, that was quite a journey. Stocks, bonds, real estate.
Investing 101, building long-term wealth.
Exactly. And as you're learning, thinking about all of this, ask yourself, what are your goals? How much risk are you comfortable taking? How long do you have? Investing, it's a journey, not a race.
That's a great way to put it.
Thanks for diving into this with us today. And to everyone listening, happy investing.